All right, what's up, tycoons? For today's video, we are going to be taking a look at the TIP ETF, all right, the TIPS bond ETF, ticker symbol TIP. And the reason we're doing so is because the bond market is much more massive than the stock market, and everything that Jerome Powell is doing is directly affecting the bond market much more than it's going to affect the stock market. So I think that the trade setups in trading bonds this year have been much better and much easier than trading some stocks or individual equities or, the S&P 500 index. Okay, now we're going to highlight some things that's really been interesting and how we may have marked a possible bottom on the chart. Okay, so we're going to look at the fib retracement levels. That's what all of these are right here. These are very important and very critical. And then, we're going to highlight how we have this five-wave structure. And being that we've hit our wave 5 target, it looks like we may have come to a potential bottom. Okay, but what we're going to do is we're going to head off of here and we're going to go ahead and check out this article by Charles Schwab because it's going to be able to explain this situation much better than I would, and really highlight what's been going on in the TIPS bond market in the TIPS bond ETF. So inflation is up, so why are TIPS returns down, right? Treasury inflation protected securities can be a buffer against long-term inflation, but it's possible for TIPS price declines to outpace principal adjustment in the short term. And that's been the case pretty much this year. All right. It's not normal for TIPS to fall so much as they say over here. But it's common for TIPS returns and the rate of inflation to diverge over short periods of times. So, the TIPS can help investors against inflation over the long term, but they aren't a hedge against inflation in the short run because price changes may more than offset the principal adjustment over shorter periods of times. All right. And, it says what are TIPS right here. It kind of goes into it. But basically, when inflation rises, the TIPS principal value is adjusted up, right? That's what it says right here. And if there's deflation, the principal value is adjusted lower. All right. And TIPS are backed by the full faith and credit of the US government, like, traditional treasuries. Okay. But we'll go ahead and, dive a little bit further and they'll explain why the TIPS have performed so poorly when inflation is so high. All right, and the reason is that TIPS are still bonds, and this means that their prices and yields move in opposite directions. So when the yield is going up, the price is going to go down. Now, interest rates have been, skyrocketing at a pace that we haven't seen in a very long time. We're living through some very, very historic times with these super aggressive interest rate hikes done by the Fed and Jerome Powell. We've seen 475 basis point rate hikes in a row. That has, I mean, I don't know the last time that happened, but it's very, very historic, right? And all of these times are historic. We had, the original COVID lockdown where, basically the whole world was shut down and people were just, it kind of felt like a movie where like, we were watching it from someone else's view. We're all literally forced to be locked down in the house. We're all forced to wear these masks. And the only thing we can do is really just kind of watch what's going around on the news and, see what they're portraying to everybody. But we'll move on some more and really explain what's going on. So right here, they discuss, is this normal, right? And it really breaks it down for you. But the magnitude of the losses this year isn't normal, not at all. Within the 12-month return of the TIPS index through the end of September, it's being the worst on record. So that's what I mean by, really historic times. This is the worst time on record for the 12-month return of the TIPS index through the end of September. But historically, over 1 year time horizons, there hasn't been much of a relationship between the total return of the TIPS index and change in the CPI, this consumer price index. We're gonna jump back into the chart real quick, and the reason I'm highlighting all of this and then going over that article is it may be a good time to start getting into some of the tips. All right, now none of this is financial advice. This is all just a little bit of informational, and then some of my opinions on what the chart is doing. So make sure to consult with a financial advisor for any decisions. But we have this five-wave structure down that could be potentially marking a bottom. We have this nice little channel right here that we're trying to break out of, and we're stuck here at our first fib retracement level. Now, the way that the retracement levels work, okay, is typically you'll see them retrace to the three most common levels, the 61.8, the 50%, and 38.2%, and then continue a trend, right? So what that means is basically you'll come down, you'll retrace, and then continue the trend, right? And in this case, obviously, we're in a downtrend. But what I've noticed this year that's been very significant is we've been coming up to the 78.6. So this has been faking a lot of people out. And, this a lot of the markets have done this, right? I've looked at several stocks, me and some of the other admin members, we've noted that people are looking and saying, okay, well, we're closing and holding above the 61.8% level. So we could be actually getting a reversal and heading to the upside. But what we've done multiple times is we've actually come up to the 78.6. And we like to call this the fake out level in the Discord. And that's the level that we're actually getting the trend continuation in the push downwards. Because nothing is going to move in a straight line down, right? You're going to have waves up and you're going to have waves down. And the fib retracement levels are going to give you some of those targets to look for. So, there's the first example, right? Then we come over here, and after these massive gaps down, what do we do again? We come up to the 78.6 retracement level. So, we gap down really big, we break through our 61.8% level, and then we come up here to the 78.6 and ultimately drop down lower. So if we look at currently what the chart has on the and the patterns that we're looking at, we're at the top of this little channel right here, this slight bullish channel, really just consolidating and slightly moving higher. We hit resistance right here at our first 38.2 retracement level. There is a possibility we could get a breakout here and head back up to our 78.6 retracement level. Okay, now if we do that, that's going to be a very, very important area to watch for a rejection, right? For a fake out, because we've done it multiple times already this year where we come down and then we come up to this level and then get rejected and end up heading back down lower. But for now, we're at two major resistance levels, right? We have the top of our channel here, and then we have the 38.2 retracement level. We could end up seeing a breakout in this, and that might take the stock market a little bit higher as well too. We may see the stock market, have a breakout here in the next week or two, or we're going to see a rejection here and continue heading lower and really just trading in this channel here. So that's the main thing that I'm watching now is, are we going to break out of this channel right here and create new lows, right? Or are we going to break out to the upside and potentially come back up to our 78.6 retracement level and repeat that pattern? Now, the prices of the TIPS ETF has fallen so significantly that it may actually be a good time to start looking for it for some of the long-term holds, right? And in the article, go ahead and go over that. We'll take a look real quick. We highlighted already before that when the yields go up, okay, the price is going to go down. They move in opposite directions. So one thing I want to highlight is that the TIPS yields haven't just risen sharply this year. Many are at more than 10-year highs, indicated by this graph here. Okay, and this is from Bloomberg. This is using Bloomberg's data, but that's really, really important. So with tip yields at their highest levels in more than 10 years, we don't see much more room for additional upside. And they're speaking on the yields. So they're saying basically that they don't see much room for additional downside on the price of the yields, on the price of the actual bonds themselves. So given that outlook, we don't expect prices to fall much further, but we do expect volatility to remain elevated as the Fed aggressively hikes rates. And we discussed that, and that's really one of the reasons that the yields have climbed so much is because of the super aggressive Fed rate hikes. But again, we got to take into consideration that the yields on these are at 10-year highs. So if we look at the chart and basically go over what they were saying here about how they don't expect prices to fall much further, right? It looks like we already hit our bottom because we got a nice 5-wave structure to the downside. Okay. And that, marks a potential bottom. And we have this slight little bullish channel here. So I'm really going to be paying attention. Are we going to break out of this channel? Okay. And if we do so, we really need to pay attention to the 78.6 because that is really the level that people have been getting faked out at and looking for a continued breakout and ultimately coming back down and getting rejected, right? It happened over here. It happened over here. It's happened multiple times. And that's really the thing that we all need to watch out for and be cautious of. But I'm going to be paying close attention to the TIPS bond ETF and seeing how things relate. We have a lot of catalysts coming up in December. So it's going to be very important to watch. We have the next CPI, the next PPI. Jerome Powell is going to be announcing the next Fed rate hike at the next FOMC meeting. And again, I just want to highlight that everything Jerome Powell does directly affects the bond market, much more than it does the stock market. And the bond market is much more massive than the stock market. So it's really good to pay close attention and look for the setups because, again, everything he's doing is going to affect the bond market directly, and it will give you, some good setups. Okay, you can trade off of what Jerome Powell is doing using the bonds a lot easier and a lot more effectively, because again, everything he does will directly correlate to the yields and the prices of the bonds. So thanks for watching the video. That's it for today. Don't forget to smash the like button and subscribe, and with that being said, I'm out.